Welcome to the Daily Update, where I'll go over the action in the market for Monday, March 27th, and then we'll see how things look for Tuesday, March 28th. We had another incremental up day. Short term is turning more positive. We're showing some improvement in the intermediate term, but at the same time, you have so many disbelievers that the market can go up right now that volume is really tapering off. So we want to keep an eye on that, but we are seeing some improvement with our charts. A little bit of housekeeping to take care of. From April 22nd through May 11th, I will be traveling. My intention is to do videos. During that time, I'll at least try to do the daily videos. I'm going to try to do the weekly video and the intermarket analysis videos and the deep dive video if I'm able to do that. Also, I have launched a podcast now on YouTube. It's the same as these videos that you're watching right now. I'm undecided yet if I'm going to actually make a separate podcast. I'll play around with that a little bit. So if you like the idea of podcasts, please feel free to check those out. All of the PDFs will be available in the description, not only for this video, but for the podcast. If you want to go through and follow the charts one by one and the slides that I use, you can download that very easily to look things over as you're listening. All right, let's go back and talk about what happened. We did have a gap higher open. We didn't really have any negative banking news over the weekend. Prices initially climbed above R1 at $39.93, and we got above 4,000. Unfortunately, that set the high for the day. As the day went on, we retraced all the way down to the unchanged level. That's that built-in support level on an up day. Then we bounced back up to R1. There was some late-day selling, which took prices well off of the high for the day. We were up 1.6% on below average volume. That is a warning sign. The technicals, as I said, are improving a little bit, and I have lots of charts to show you. Inflation and interest rates are the real backdrop to what's happening right now. Any Fed speak that we may get, and then is this banking situation coming to the end, or is it just beginning, or are we in the middle? We're still trying to figure that out. Here's the intraday chart showing how we gapped up above R1. That was the high. We came all the way down to the unchanged level. Danced around this level for a little bit before going back up to R1 and then seeing some selling going into the close. Here's a look at large cap growth versus value, where they both did fairly well during the day but then saw some late day weakness. Growth underperformed value, at least in the large caps, where it was down where value had been up. And we're seeing a little bit of a shift right now in the market, where the mid caps growth did better and also in the small caps. Here's the intraday chart. We were pretty much flat in the overnight session starting on Sunday. Then the futures started to get a little bit more positive. We took that into the open, came all the way down to the unchanged level, bounced back up, came back down with some late day selling, and currently are drifting sideways. So what are some comments that we can make? Small caps and mid caps, which really been getting hammered lately, they did well in Monday's session. Areas that have seen recent strength saw weakness, and areas that have been weak lately saw some strength, just the reverse of what's been happening. Another bit of news that had a little impact on the market. First Citizens Bank shares, they'll acquire $72 billion of Silicon Valley Bank's assets at a discount of $16.5 billion. Also, U.S. authorities are considering expanding an emergency lending facility for banks in ways that would give First Republic Bank, the bank that's been in the news a lot lately, more time to shore up its balance sheet. So they're switching things around to make it not look so bad. On a short-term basis, our Stochh RSI is the only extreme positive reading that we're getting, and we can use that more as a momentum indicator to suggest that things are turning a bit more positive. The dollar was down and interest rates were up, so that's a reverse of what we've seen, especially with interest rates lately. We have the 30 to the 5 that's back to being normal now, but all of our other yield curves remain inverted. Sentiment is still in the negative camp. It ticked up with the up day. It was at 33, and after Monday, it came in at 36. Our trend is still negative. The red line's on top, but it is weakening because it's below the moving average, and it's also below 20. Our bias is still positive. We've had 3 up days in a row. Not big gangbuster days, but they're still positive nonetheless. And I'm still keeping our momentum at mixed. We're not really seeing that real conviction yet, supported by volume, to turn things back more positive. We didn't have any economic reports that came out in Monday's session. Here's the Isabel Net charts. This first chart shows where the S&P 500 repurchasing spending really declined. You would think if companies are more positive on not only the market, but in their own individual company, that they would be buying back more shares. Well, we're actually seeing this really trailing off. Another chart suggests that current market pricing for the Fed funds rate, they're expecting it to be at about 4.9% before it starts to come down to 2.9% in December of 2024. So that's quite a ways out. This chart just says the dollar sell-off has more to go. When you compare it to the yield curve, and you can see kind of a relationship between the black line and the gold line here, where they often move in the same general direction. They shift this forward about a year, and if it follows this same basic relationship, the black line, which is the dollar, could have more weakness. They're still expecting GDP to be positive. The consensus are these black diamonds here, where Goldman Sachs is still predicting positive GDP. The next chart is put out by the Fed, and it just shows where all commercial bank deposits have really been going down as people are losing some faith in the banking system. Another one just says that investors are more bearish on real estate. The next chart just compares the yield curve inversion from the 2-year to the 10-year. That's the dark blue line. And then initial jobless claims, where they have a tendency to go in the same general direction. That's kind of the last shoe that we're really waiting for to drop, is the employment situation. When we really see a tick up in weekly jobless claims and then that feeding over into the employment situation report, that could suggest that the economy is really starting to slow down. One thing that's been in the news a lot lately is this thing called the Fed discount window. This is where banks go to get short-term lending, where the S&P 500 is the blue line, and this black line is the Fed discount window usage. How often are banks using this? It's really spiked up since this banking crisis has come into the news. Then looking at some Edward Yardeni information, over the weekend he came out with a chart. Here's the S&P and the 10-year Treasury yield. But what he said is over on the right-hand side. Bond investors have been waiting for something to break in the financial system since last summer when the yield curve inverted. They're betting that something broke when Silicon Valley Bank imploded. Overnight, this event raised fears of a widespread banking crisis, credit crunch, recession, and even deflation, which is why we're keeping more of an eye on the banking situation currently. Then also in that same email, Joe Feshbach is quoted as saying, "Thus, I have concluded that if the market does continue Friday's rally, the sentiment indicators are not just good enough to support a really good rally, and I'd rather wait for more improvement before getting too optimistic short term." We're seeing improvement in our charts, but this is kind of the reason why there's a lot of people waiting on the sideline. They don't really trust what's happening right now. And in fact, in Monday's session, we actually saw selling into strength. Also, in Tuesday's email, Edward Yardeni said that the FDIC estimated that Silicon Valley Bank's failure will cost the deposit insurance fund around $20 billion. With the exact amount not really sure yet. The deposit insurance fund had a balance of $128 billion at the end of last year. Here's the chart. And then I drew this red line here. If they take $20 billion out, that's just what we know about so far. That would really deplete the overall balance in the deposit insurance fund. Then at the end of this, Edward Yardeni says there could be more mergers and acquisitions among the regional banks. To avert disintermediation, they will have to raise their deposit rates, which will squeeze their profitability. That could force many of them to consolidate to lower their costs. Now, going into the charts that we look at, the Ulcer Index has dropped below the moving average. We pretty much went sideways, so fear is not changing an awful lot currently. Here's the VIX. With the update, the VIX did decline on the line chart as well as on the bar chart. And the VIX of the VIX also shows that volatility is continuing to decrease. The equity put call ratio, when we spike up and come back down, that often gives support to the S&P. We could be getting some of our positive backdrop from this, but it's not really feeding into a gangbuster upward move, at least yet. Also, looking at one of the fear gauges, we're ticking back up slightly when you compare shorter-term bonds with investment-grade bonds. When this line is going down, fear is decreasing. When this line is going up, fear is increasing. Another fear gauge that we look at are shorter-term bonds with the equal weight S&P 500. This is starting to spike up a little bit, showing that there's still some fear in the market. And then looking at risk on, risk off, we're coming back down. So folks are still having a tendency to get more into bonds after they get out of stocks. That's risk off. If they're going into stocks, that's considered risk on. Looking at the trend, the red line's on top, so we default to negative. The ADX is below the moving average and declining and well below 20. The daily chart shows that we're right in between the 200-day simple moving average and the 50. We're still above this downward sloping trend line, so that is positive. So far, support has been holding. But if you look at the bottom, you can see where volume has been tapering off. And here's a 2-year look at that same chart. Then here's another chart from Isabel Net. Pretty much the same chart that I've been showing, only this is a weekly chart showing the downward sloping trend line, how we're above the 200-week moving average. And so far, these levels have been holding up okay. The Arun is showing a little bit of improvement after giving us an extreme negative reading, but it is still negative overall. The Stochk RSI is getting into extreme positive territory, which, as I said before, could show a good momentum move, but we get to the point where we're overextended to the upside, and that produces a short-term overbought condition. Then the Williams percent R is not extreme, but I just wanted to show how it is above 50 and improving. The stochastic study in the short term showing a lot of improvement, as well as the intermediate term, and our long term continues to go higher. The force index is still above 0 and advancing, so that's positive. And we're above both the exponential and simple moving average. So in the short term, we're still positive. Intermediate term, we're right in between the simple and exponential moving average. So that's improving, but not turning positive yet. And the 100-period moving average, we're above both of those, and so far this exponential moving average has been providing support. And looking at our moving average tree, it's hard to get anything from this when we're right in the middle of the whole mess. The Swinland Trading Oscillator based on price and volume are above 0 and advancing, so that is positive. And our oscillators are looking a lot more positive. The short-term oscillators are now going up. Intermediate term, we have the MACD, the PMO is just crossing, and the PPO is cross positive. Longer term, we're crossing over with the tricks, and we've already crossed over with the KST. The parabolic SAR continues to be positive with the dots below. The Chaikin oscillator, this is showing a little bit of weakness. We're above 0, so we're positive, but the oscillator itself is declining. And the vortex is still negative with the red line on top, even though it is declining. One that I don't show quite often is the ultimate oscillator. We're below 50 and declining, so that is negative. The RSI showing some improvement, both with the 14 and the 9 period, we're above 50 and advancing. Our Ichimoku cloud, we still have a lot of the cloud above current price. Can we go into that and then eventually break above it? The PMO looks like it's crossing right now, but if you look down below, based on price and volume, we have already crossed positive. In our PMO study, showing some improvement with the PMOs that are rising, the buy signals are improving, and we're starting to flatten out with the percent of PMOs above 0. Here's a different look at the bullish percent index. Over the weekend, I was looking at this chart going, hey, wait a minute, we see a negative divergence here where the BPI made a lower high, but yet with the S&P, we made a little bit of a higher high. So that is suggesting we saw some weakness after that. Then if you look at the low that we set where we were chopping sideways for quite a while, and then we went up and came back down, you'll notice we came right back down to about the December lows, but the BPI made a lower low, and that could be taken as a positive divergence since price didn't fall as much. Looking at our broader measure, BPI, we're pretty much chopping around, but we're still above this 30 line. However, this is more negative than positive. The Chaikin money flow is still above 0 and now starting to go sideways. The balance of power is positive. We're above the dashed line and advancing. The TTM squeeze is showing some improvement, but not enough to draw in a blue bar yet. The go, no go is still more negative with the deep purple smoke on the water bars, and we're above the 200-day simple moving average. Looking at our short-term fib levels, if we keep going up, we might have resistance at the 4004 level. If we continue to fall down, we're looking at about the 3908 level. Then on our longer-term fib chart, we still have overhead resistance at about 4,000 if you round this up. Our longer-term fib level, if we keep going up, we have resistance at 4,020. If we fall, we're looking at the 3826 level. And the bigger stocks in the S&P have been outperforming the equal weight index, but it did fall back in Monday's session. The Elder Impulse system for the S&P is still positive. The McClellan oscillator has now crossed back above 0, and that is turning positive. The broader range McClellan oscillator has now also crossed above 0, so that is positive. The summation index based on price is turned up as well as volume. and sometimes volume leads price by a few days. We did see a little bit of an improvement with our new highs and new lows, with more new highs than new lows in Monday session, so our 5 period is starting to turn back up, and our 10 period is also turning back up. So we're seeing a little bit of strength internally. The advanced decline line showing a little bit of improvement. We are just a little bit above the moving average based on price, but this could be also a negative divergence where we're not confirming that based on volume. The advanced decline ratio is still below 0, but showing some improvement. Accumulation distribution is still above the moving average, but showing some weakness. We're dropping off now with volume. And looking at the financial sector to the S&P, it bounced up slightly in Monday's session. The bank ETF was up over 2%. The regional ETF was up 2.25%. And the other banking ETF was up 0.87%. The ratio between the regional banking sector and the financial sector did show a little bit of improvement. And First Republic Bank was up almost 12%. The Dow is still in between the 50 and 200-day moving average, but we did get back above the 200-day moving average. The diamonds are positive. NASDAQ, recent golden cross, and pulling back from higher levels. And the NASDAQ 100 is still above this pivot level after giving us a recent golden cross. The Elder Impulse system for the Qs is switched to neutral. If we continue to go up with the NASDAQ 100, we have a 38.2% retracement level, which stalled things out before. That's at the 12,868 level. And right now we're at 12,673. Another chart that I'm keeping an eye on now are the micro caps. These are the real small companies. And I brought this out in the weekly video. When the big stocks were outperforming the mid caps and the small caps, I was taking that as positive. And that is positive. But at the same time, you can have too much of a good thing. If the mid caps, small caps, and the really small caps start to show continued weakness, that eventually could feed over into the market and produce some weakness. The reason I bring this chart up is even though the market has been improving a lot lately, last week the micro caps, anywhere from 50 million to 300 million with their market capitalization, set a new 52-week low. So we just want to keep an eye on this one. And then the small caps, which are a little bit bigger but still small, did have a pretty good up day. They were up over 1%. Here's the Russell 2000 small cap index. The MACD is actually trying to turn up a little bit. The RSI is showing a little bit of improvement, and we're still maintaining price above this support level. So things could be improving for the small caps. And the Elder Impulse system for the small caps still has them at neutral. And the ratio between small caps and the S&P did improve slightly, but has seen a lot of real recent weakness. The mid caps did show some improvement in Monday's session, and the Elder Impulse system for the mid caps continues to be neutral. Looking at the home builders, the relationship between home builders and the S&P is getting a little bit stronger. The Copic curve has just generated a recent buy signal, and the Pring bottom fisher also gave us a recent buy signal. Bond yields really shot up in Monday's session as we're seeing a reversal of what's been happening over the last week or so. And bond prices are now falling. They're still positive with the RSI declining, but it's still above 50, and the MACD is rolling over a bit, but it's still positive. Looking at our long-term trend, this is where we're trying to determine if this breakout above the downward sloping trend line was for real or if it's going to turn out to be a fake out. We can't really get an answer right now because the MACD continues to be right on top of the moving average. An update of our possible positive scenarios showing some improvement with our 19-day exponential moving average of the advanced decline ratio. Based on price, we're a little bit above 0. We haven't crossed above 0 yet based on volume. Looking at our growth to value ratio, still doing good overall, even though Monday saw some weakness with the Qs to the S&P. Discretionary showing a little bit more weakness. Large cap growth turned down against large cap value, but is still in an overall uptrend. And then our growth to value ratios with the large caps, mid caps, and small caps are still positive, but did see some weakness in Monday's session. This is another thing we're watching, the 50-period exponential moving average of the new highs minus the new lows. It continues to drop below 0, but if you look at the indicator, it actually went positive for the first time in a number of days. So that might help this indicator to turn back up if we can stay above this 0 line. 2-year Treasury yield after spiking up and then coming back down, that often gives support to stocks. We're seeing that a little bit right now, but not the way we would really like to see that. And then our staples ticked up just slightly, but we're still working off of this major spike right here. If we do keep falling from this level, we may end up being able to work off of this spike, or this ratio could continue to go back up and we generate a new spike. So what's our outlook for Tuesday? The technicals are turning positive. The economic reports coming out, not really influential, are the advanced good trade, advanced retail inventories, and advanced wholesale inventories. We have the FHFA Housing Price Index, the S&P Case-Shiller Home Price Index, and consumer confidence. And then the whole list of geopolitical events. We're really keeping an eye on this whole banking situation to see if it's going to get worse. Is it getting better? Or is it going to stay about the same? Fed speeches that are scheduled for this week. We did have one on Monday. Then on Tuesday, we do have Vice Chair Michael Barr testifying before the Senate on Tuesday, and he will testify before the House on Wednesday. We'll have to see. Since this is during prime time when the market is open, they may latch on to some things that he says, but short of dancing on the tables or something, he may not be that influential. And then there's another speech on Friday, but it's after the market closes. Then looking at the Stock Traders Almanac statistics, we're coming up to the end of March now, so this slide will be revamped when April is upon us. For March 28th, the Dow is more neutral to negative, being up 47.6% of the time, and that's the same for the S&P, where the Nasdaq is more negative, being up only 38.1% of the time. And then these other things are supposed to be adding to the positive backdrop, but seasonally we tend to see a weak end to March. Here's a chart showing we're on the 20th trading day of the month. The green dashed line is what we're watching because this is during a presidential cycle, and it's pretty much flat to slightly higher overall. Then our scenarios. Can't really go with the down one because we're not trending and the technicals are improving. Can't really go with the up one unless you're super aggressive, but we're not trending there either. So we're still going with the sideways trend because the ADX is weakening. It's below 20. The red line's on top, so it is negative. Our conclusion, the S&P is showing improvement. Short term, it's positive. Intermediate term, it is showing improvement. Long term, we are positive because we're above the 200-day simple moving average and we had a recent golden cross. But one solid down day could shift all of that back to negative, so please be aware of that. Thank you. I hope you found this helpful. I hope you were able to check out some of the other videos over the weekend. If you're a new subscriber to watching these, I want to welcome you, and I really appreciate that. I hope you find these videos very helpful to you. Have a great day, and I will talk to you in the next video.